Hello, this week we're going to look at one of the other requests we had, which was to understand some Tom Demark indicators. And we're going to look at, by far his most popular ones, which are sequential and combo. I would say they represent probably 95% of any questions or any systems I ever build. We'll touch on how you can connect that with other types of analysis, and Demark studies are available on a variety of professional platforms. But if you email demark@cqg.com, there are some specific white label products that will give you various levels of sophistication associated with those studies. First one we're looking at is what's called TD sequential, and what we have is two types of analysis. When you look at a chart, you'll see a series of blue numbers which will go up to the number 9, and then after that you'll see some red numbers that can go up to 13. First of all, we're looking at the blue ones, and so the setup for buying is to say that when the close is less than the close 4 bars previously, it's going to produce a number, and once that's done that 9 times in a row, it's going to finish with that number 9. Obviously for sell signals it's the opposite. There are a few qualifications associated with that, and ideally a sell setup should have numbers 8 or 9 above 6 and 7, and any tests that I've done in the past via the signal evaluation tool, I've actually just done 9 against 7. Finally, we have to understand what a failure of a setup is. If a sell setup is above the previous buy setup, number 1, the setup may fail and countdown begin or continue. So what we're really saying here is that to get these blue 9s, which means that we're looking for a reaction to a trend, it has to be properly defined, otherwise there's more likelihood that what can happen is what's called recycling. And the way that we reference this is by using another study, which is the TDST line, which is normally a blue or red horizontal point that references that number 1. So here we have a chart, and this is to show how this can be qualified. I've actually built some custom studies that record those lines, the red or the blue lines, and what I have here is what I'm interested in is where I've had a blue 9, so it's fulfilled it, but it was above the previous red line where another setup occurred. So this would be an example where we've had a correction to the trend, we get the blue 9, and it says that the trend in this case should start once more. So that's the blue 9s very quickly. Now we have, after a setup, we have the definition for countdown, and what this says is that the close has to be less than the close 2 bars previously, and this has to happen 13 times, but not on a consecutive basis. And once this has happened, then we are looking for a potential of a change in trend. So we have a blue 9, and then another process begins, and then we end up with a red 13. Now it says that we're looking for the change. Now there are some other qualifiers associated with that, and you can see that there's some dashes here, or stars, and then eventually it produces a 13. And this is an extra qualification that says that for the 13 to be true in a sell signal, that close has to be, or the high, it can be different ways, has to be beyond the red 8. So here's another one down here where we had a little star and then finally it fulfilled itself. That's just the qualifier associated with it. So we must have for a buy setup that 13 is less than 8, and for a sell setup that 13 is greater than 8. If the close is identical, then it is also qualified, and that's what's regarded as what is called a termination count. Now I've done a huge number of tests on Demark studies some years ago. I had a project that an arcade asked me to do, where I looked at all the studies in the suite to a PowerPoint that was over 1,000 slides, and looked at ways of taking these raw signals on sequential or on combo and seeing whether there was ways of improving them. And what I did here was take my own volatility time bands and say that for a signal to be true, then price, if it was a buy, had to be at least gone below 1 standard deviation down, and if it was a sell signal, 1 standard deviation up. What this did was cut signals considerably without cutting the profitability as much. Now within the sequential study, you also have a way of working out an automatic stop loss. And once say 13 has appeared, then a dash will go beyond that high or low, and it is qualified based on what is the high of the trend for the range of that bar that is then projected above the high of that 13 bar. If it's not the high, then it takes a slightly different calculation. The principle behind this, if I get a 13 here, it produces the red dash all the way here. One of the potential issues with this is the higher the time frame chart you're actually looking at, it means that risk can be considerable if the 13 bar had a very wide range, or if it's taking that other calculation. And so unless you're using it for very low time frame charts, then often that risk is too wide for most people. I also think personally that there's easier and better ways to quantify risk. If we're trying to pick tops and bottoms, we can argue that if that top or bottom is actually broken, especially on a closing basis, then the signal is deemed to have failed. And here's an example here where a 13 was on a very, very wide bar, which produced a stop that was all the way up here, whereas a 13 that occurred here, the stop was much, much closer.